Welcome to the Deep Dive. Today we're plunging into initial public offerings, or, well, IPOs.
IPOs, yeah.
You've probably heard the term thrown around, especially when some big private company decides it's time to hit the public stock market.
Exactly. An IPO is basically the very first time a company that was privately owned sells shares to the general public.
So it's moving from being owned by just a few people to potentially thousands.
Precisely. It's that transition point. People often just call it going public.
And for this deep dive, we've looked at quite a bit of material explaining, the whole process, the history behind it, the good and the bad for the company, and maybe most importantly, what it means if you're thinking about investing.
Right. There's a lot to unpack there.
Our mission today is really to pull out the key stuff, the most important nuggets about IPOs, so you can understand what they are, how they actually work, and why they matter without getting bogged down in, super technical jargon.
Yeah, keep it understandable.
So let's kick things off with the big question. What exactly is an IPO? And, why do companies even go through this whole complex thing?
Well, the number one reason, usually, is money. It's about raising a significant amount of capital.
Okay, like funding for growth.
Exactly. Funding growth, maybe paying down debt, investing in R&D, acquiring another company, lots of potential uses. It's access to a much bigger pool of funds than they could likely get privately.
Makes sense. A big fundraising round.
Pretty much the biggest. And it's not just about the company itself. An IPO is also a huge opportunity for the early birds, the founders, the angel investors, venture capitalists.
Ones who got in early and took the risk.
Right. It gives them a chance to cash out, so to speak, sell some of their shares and see a return on their investment. It's a major liquidity event for them.
But it can't be as simple as just flipping a switch and saying, we're public now. There must be hoops to jump through.
Oh, absolutely. It's a major undertaking. Companies have to meet a whole checklist of requirements. These are set by the stock exchanges, like the New York Stock Exchange or NASDAQ, and crucially by the SEC, the Securities and Exchange Commission.
Ah, the SEC. Regulatory oversight.
Yes, they ensure transparency and protect investors. There's a lot of scrutiny involved.
So when does a company typically get to the point where they're seriously thinking about an IPO? Is there like a magic number or stage?
There's no single trigger, but often you hear about companies reaching that unicorn status, a private valuation around $1 billion. That's a common point where the conversation gets serious.
Unicorns, right.
But it's not just unicorns. Other companies may be smaller, but with really strong financials, good growth prospects, a solid path to profitability. They can also be good candidates. It depends on market conditions, too, and whether they can actually meet all the listing rules.
Okay. So beyond the big pile of cash, are there other perks to going public?
Definitely. Being public means more transparency, right? You have to report your financials regularly. That scrutiny can actually make it easier to borrow money later on, maybe get better loan terms.
Interesting. Because lenders see you as less risky.
Potentially, yes. And there's the visibility factor. Being listed on a major exchange gives you a certain prestige, credibility. It can boost your public image, which might even help sales.
Like a stamp of legitimacy, almost.
Yeah.
Now, stepping back a bit, this isn't a new invention, is it? Where did IPOs come from historically?
Good question. It feels very modern, but the concept goes way back. The first thing that really looks like a modern IPO was actually the Dutch East India Company.
Really? How far back are we talking?
Early 17th century. Back in 1602, they offered shares to the public to finance their voyages.
Wow, so this has been around for centuries.
In various forms, yes. It's become, a standard tool in the corporate finance toolkit over time, a way for companies to grow by selling ownership stakes.
And I bet the popularity of IPOs has waxed and waned over time.
Oh, for sure. You see clear cycles. Economic booms often bring a wave of IPOs. Think about the dot-com bubble in the late 90s. Tons of tech companies went public, some without even making a profit yet.
I remember that. Lots of hype.
A lot of hype. Then, conversely, something like the 2008 financial crisis puts a real damper on things. IPO activity slowed right down. More recently, there's been all this focus on these big tech unicorns and whether or when they'll finally go public.
Right. So, okay, a company decides, yes, IPO is the way forward. What actually happens? Can you walk us through the mechanics of it, the process?
Sure. You can broadly think of it in two main phases. There's the pre-marketing phase and then the IPO event itself. It usually starts when a company decides to test the waters, maybe talking confidentially with investment banks.
Investment banks, the
Yeah.
underwriters, right? They seem pretty key.
Absolutely central. The company chooses one or more lead underwriters. These banks do a ton of work. They help prepare all the legal and financial documents.
Like the S1 form. I've heard of that.
Exactly. The S1 is the big registration statement filed with the SEC. It's massive. It contains everything: financials, risks, management details, the offering specifics. Part of it becomes the prospectus, which is the document for potential investors.
Okay, so they handle the paperwork. What else?
They create that prospectus, they structure the deal, and critically, they organize the roadshow.
A road show. Sounds like they're going on tour.
Kinda, yeah. The
Yeah.
company execs and the bankers travel around, usually virtually these days too, meeting with big institutional investors, pension funds, mutual funds, hedge funds.
Pitching the company.
Exactly. Selling the story, the potential. The
Yeah.
feedback they get from these big players is crucial for figuring out how much demand there is for the stock and ultimately what the right price should be.
Okay, so let's map out the steps then. How does it unfold?
It's quite a sequence. First, different investment banks pitch the company they present, proposals outlining their services, what kind of stock to issue, potential price range, number of shares, and a timeline.
Like a beauty contest for bankers.
Sort of. The company picks its lead underwriters and they sign a formal underwriting agreement. Then they assemble the IPO teams.
Teams. Plural.
Yeah, it involves the underwriters, specialized lawyers, CPAs for the accounting side, SEC experts,
Mhm.
a lot of cooks in the kitchen, all focused on getting this right.
Sounds expensive already.
It is. Then comes the heavy lifting on documentation, primarily that S1 registration statement for the SEC. It has the public prospectus part and a section with more private details. It gets filed, but it's not final.
It gets revised.
Oh, yeah, constantly. They update it based on new info, feedback, SEC comments. It's a living document right up until the IPO.
So while the lawyers and accountants are buried in paperwork, what about the selling part?
Parallel track. Marketing materials are being created, the roadshow is happening, management and the underwriters are actively talking to those institutional investors, trying to build the book of demand.
Building the book.
Yeah, figuring out who wants how many shares at what price. Based on that feedback, they might tweak the price range or even the timing of the IPO. And all along, the company's also working to make sure it meets all the specific rules of the stock exchange it wants to list on, plus the SEC's rules.
Okay, so they finally land on a price. The demand seems solid. What happens on the actual IPO day?
Right before the IPO date, they finalize the public board of directors. They also have to set up all the internal systems for regular financial reporting, quarterly earnings calls, filings, all that stuff public companies have to do.
Right, the ongoing obligation.
Exactly. Then, on IPO day, the shares are officially issued. The money from selling those shares flows into the company, becomes cash on their balance sheet, recorded as stockholders' equity.
And boom, they're public. That's it.
Pretty much, although there can be some post-IPO details, like underwriters often have a green shoe option.
Green shoe.
Yeah, it lets them buy a certain number of extra shares from the company at the IPO price shortly after trading starts. It helps stabilize the price if demand is super high initially.
Okay. And you mentioned quiet periods.
Right. Insiders, employees, early investors are usually subject to a lockup period. They're legally barred from selling their shares for a set time after the IPO.
We should definitely talk more about that lockup. But first, big picture.
Yeah.
What are the main upsides and downsides for a company going through all this? Let's start with the pros.
Okay. Advantages. Number one, as we said, access to a huge amount of capital from public investors. That's the main driver.
Right. Money for growth.
Also, having publicly traded stock can make it easier to buy other companies. You can use your stock as currency in acquisitions.
Ah, okay. Stock swaps.
Exactly. Then there's the increased visibility and prestige we talked about. Being listed can enhance your brand, potentially boost sales and profits.
And the better credit terms you mentioned earlier.
Yes, that transparency often leads to more favorable borrowing conditions. Plus, having liquid stock is a great tool for attracting and retaining talented employees. Think stock options.
Makes sense. Compensation beyond just salary.
And long term, it opens the door for future fundraising, like selling more shares later in secondary offerings. It can potentially lower your overall cost of capital, too.
Okay, those are some pretty strong arguments for going public. What about the flip side? The disadvantages.
Well, it's very expensive. The IPO process itself costs millions in legal, accounting, and underwriting fees. And the costs don't stop there.
Ongoing costs.
Yeah, being a public company means continuous reporting, compliance, investor relations. It's a significant ongoing expense. It also takes up a lot of management time and focus, preparing quarterly reports, dealing with analysts. It's demanding.
I can imagine. What else?
Loss of control. When your ownership is spread out among public shareholders, the original founders and investors inevitably own a smaller slice. They have less direct say.
So decision-making changes.
It can. And you can run into agency problems where management's interests might not perfectly align with all the shareholders. Plus, there's the relentless focus on the stock price.
Quarter-to-quarter pressure.
Exactly. Management can get distracted by short-term stock moves instead of focusing purely on the long-term health of the business. And finally, disclosure.
Having to reveal secrets.
Well, maybe not secrets, but a lot of sensitive information. Detailed financials, business strategies, operational methods, stuff your competitors would love to know. You have to put it out there.
So definitely a trade-off. Big potential rewards, but also big costs and challenges. Are there other ways for a company to get onto the public markets besides this traditional IPO route?
Yes, a couple of main alternatives are worth mentioning. One is a direct listing.
Direct listing. How's that different?
Basically, the company lists its existing shares on an exchange without hiring underwriters to raise new capital or stabilize the price in the same way. Employees and early investors can sell their shares directly to the public.
So no new money for the company, just liquidity for existing shareholders. And less handholding from banks.
Generally, yes. It's simpler, cheaper, but also potentially riskier for the company in terms of price volatility. It tends to work better for companies that are already really well-known big brands.
Okay, and the other one?
A Dutch auction. This is a different way of pricing the IPO, instead of the underwriter setting a price after the roadshow.
Yeah.
Potential buyers submit bids saying how many shares they want and what price they're willing to pay. The IPO price is then set at the highest level that allows all the shares being offered to be sold. Shares are allocated starting with the highest bidders.
Sounds more democratic, like the market truly sets the price.
That's the idea behind it, yeah.
Right.
It puts more power in the hands of the bidders compared to a traditional IPO where the underwriters have more influence on the initial price. Google used a Dutch auction for its IPO, for example.
Interesting. Okay, let's switch gears now to the investor's viewpoint. Someone listening might be thinking, should I invest in an IPO? What do they need to consider?
That's the million-dollar question, isn't it? Or potentially $1 billion, depending on the IPO. Look, companies usually go public when they think their future prospects are pretty bright, right? They want to maximize value for early investors and raise capital effectively.
So there's often an inherent optimism baked in.
Generally, yes. And to make sure the IPO is successful, meaning all the shares get sold, underwriters often price the shares at a slight discount to what they think they could get.
A bit of a sweetener to attract buyers.
Exactly. That initial discount is part of what makes IPOs potentially attractive for investors looking for a quick pop. But how do they arrive at that price in the first place?
Yeah, it's not just plucked out of thin air, right?
Definitely not. The underwriters do a lot of valuation work. A common method is discounted cash flow, or DCF.
DCF, estimating future profits and discounting them back.
That's the core idea. Projecting future cash flows and figuring out their present value on a per-share basis. They also look at comparable companies, other public firms in the same industry, and see how they're valued based on metrics like revenue or earnings multiples.
So financial modeling plus looking at peers.
Right. And then they factor in the demand they saw during the roadshow. But even with strong demand, they usually leave a little bit on the table, price it slightly below the maximum possible to encourage that first-day trading activity.
Okay, so as an individual investor, how do you even start to figure out if an IPO is a good bet? There's no long public track record to look at.
That's where the prospectus, the S-1 filing, becomes absolutely critical. It's your main source of info.
What should you look for in there?
You really need to dig in. Look at the management team. Who are they? What's their experience? Read the section where management discusses the business, the risks, their strategy, the MD&A section. Understand the business model. How do they make money? What are the competitive threats?
And the underwriters matter too, right?
Yeah. Yes. Look at who the lead underwriters are. Are they reputable firms with a good track record of bringing successful IPOs to market? That can be an indicator, though not a guarantee, of quality. And understand the specifics of the deal. How much money are they raising? What will they use it for?
So homework is crucial. Read the prospectus.
Absolutely essential. Don't just rely on the hype.
Okay, say you've done the reading, you're interested. How does an average person actually buy shares in an IPO? It's not like buying regular stock, is it?
Not quite. That pre-marketing phase, the roadshow, that's mostly for the big institutional guys. Their interest heavily influences the opening day. Individual investors usually get access much closer to the actual IPO date or even on the day itself.
Through the regular broker.
You generally need an account with a brokerage firm that gets an allocation of shares in that specific IPO. Not all brokers get allocations for every IPO, and even if they do, they might prioritize larger clients.
So you might not get as many shares as you want.
Very possibly. Demand from retail investors often outstrips the supply allocated to them, especially for popular IPOs. You might put in an order for 100 shares and only get 20, or sometimes none at all.
Right. Okay, let's say you manage to get some shares. What happens next? Performance-wise, are IPOs generally winners?
It's really a mixed bag. IPO returns are watched like a hawk, but they can be incredibly volatile. Some high-profile IPOs actually drop below their offering price initially. But yes, many IPOs do see that pop on the first day or in the first few weeks. That initial discount and the buzz can drive the price up. But investors really need to be aware of factors that influence performance beyond day one.
Like those lockup periods we mentioned. Tell me more about that.
Okay, the lockup period. This is key. If you look at stock charts for companies after the IPO, you often see a dip in the price, maybe 3 to 6 months out, sometimes longer.
Why does that happen?
It often coincides with the lockup expiration. Remember, insiders, executives, employees, early VCs are typically barred from selling their shares for a set period, usually 90 to 180 days, sometimes up to 2 years.
To prevent them from dumping shares immediately.
Exactly. But when that period ends, suddenly a whole lot of shares held by insiders become eligible to be sold on the open market. This big increase in potential supply can push the stock price down, even if the company's fundamentals haven't changed.
So, a predictable point of potential selling pressure.
Very predictable. Savvy investors watch those lockup expiration dates closely. It creates this sort of artificial scarcity early on, helping the initial price, but then introduces potential instability later.
That's a really important dynamic. What about waiting periods? You touched on that briefly.
Right, that's slightly different. It relates more to the underwriters. Sometimes the underwriting agreement includes a provision where the underwriter set aside some shares they can choose to buy themselves after a certain waiting period.
So if they buy them, it could boost the price.
Potentially, it shows continued confidence. If they don't exercise that option, it could be seen negatively. It's another factor that can influence price movements post-IPO.
And flipping. That sounds like trying to make a quick buck.
It is. Flipping is just buying IPO shares with the specific intention of selling them very quickly, maybe hours or days later, to profit from that initial price increase.
Does it work?
It can, especially if the IPO was priced attractively and there's strong initial demand causing a big first-day jump. But it's obviously a short-term speculative strategy.
Okay. Now, you also mentioned tracking stocks. What are those about in the IPO context?
Right, tracking stocks are a bit different. This happens when a large, diversified company decides to create a separate stock that tracks the performance of one specific part of its business, one division or subsidiary.
Like spinning off a division, but not fully.
Kind of. The parent company usually still retains control, but issues these new shares that are supposed to reflect the value and growth of just that specific unit. The idea is that maybe that particular unit is undervalued within the larger company, and creating a tracking stock will unlock its value.
Are these interesting for IPO investors?
They can be. Because the business unit usually has an operating history within the parent company, there's often more financial data available than for a brand new company going public. This might mean a bit less uncertainty and potentially less initial volatility.
More history to analyze.
Yeah.
Makes sense. Any final sort of words of wisdom or caution for someone thinking about jumping into the IPO market?
Yeah, I think the main thing is be wary of the hype. IPOs, especially for well-known tech companies, can generate enormous buzz. Media attention, social media chatter. It can create excitement that isn't always justified by the company's actual business prospects or valuation.
Don't get swept up in the frenzy.
Exactly. Do your own research. Read that S1. Understand the business, the risks, the valuation. Look beyond the headline noise.
Solid advice. So, just to wrap things up then, an IPO is clearly a massive step for a company. It's their debut on the public stage, with huge implications for them and for potential investors.
Absolutely. It's this complex process full of potential benefits like raising capital and gaining visibility, but also fraught with challenges like high costs, loss of control, and intense scrutiny.
And for investors, it can be tempting, especially with that possibility of a first-day pop.
But it comes with real risks. Understanding the lockup periods, the valuation, and especially digging into that prospectus is just crucial before putting any money down. Information is key.
Definitely. And maybe that leads to a final thought for our listeners to chew on. We know IPOs generate buzz and the dream of quick profits. But beyond that initial hype, what other factors, what deeper considerations should a really thoughtful investor be weighing before diving into a new IPO? Something to think about.
Good question to ponder.
Thanks for joining us for this deep dive today.